the financial experiment that couldn't be reversed. It started as a solution, then it became a habit, and now it's a system nobody knows how to escape. To understand the financial experiment that couldn't be reversed, we need to go back to the moment modern finance stopped being an instrument and became an environment, a set of rules and incentives so embedded in daily life that removing them would feel like removing gravity. And today, this matters because we are living inside the experiment, not watching it from the outside. Every salary deposit, every mortgage payment, every pension contribution, every interest rate decision is part of the same machine, a machine that was built for growth, speed, and stability. But stability has a cost. The first beat of this story begins with credit. Credit was supposed to be a tool, a way to smooth trade, fund expansion, and bridge time. Borrow now, pay later. A simple concept that helped economies evolve. London became one of the places where this tool was refined into an art and then into a global standard. Then the second beat arrives. Debt becomes normal, not just for businesses, but for households, not just for governments, but for entire societies. Borrowing stops being an exception and becomes a default. People begin living in a world where the future is constantly being pulled into present. Homes are bought with decades of promises. Nations run on rolling refinancing. Markets expand on leverage. And then the third beat begins to form. The system becomes dependent on expansion. Because once debt is normal, the economy needs growth to sustain it. Growth becomes more than ambition. It becomes survival. Interest must be paid. Refinancing must be possible. Confidence must remain intact. The machine must keep moving. Because slowing down will reveal how much of the present is built on tomorrow's income. At first, it feels like progress. A world building faster than ever. A world expanding opportunity. A world creating wealth at scale. But beneath the surface, the experiment changes its nature. It stops being optional. It becomes irreversible. And that's where this story begins to turn. Because the moment a system depends on growth, it stops being a choice. It becomes a requirement. London's role in this experiment is not about one policy or one institution. It's about the way the city helped normalize a world where finance expands through credit and credit expands through belief. Once that belief is established, reversing becomes almost impossible. The first layer of the reveal is that debt creates momentum. A government borrows to stabilize. A company borrows to expand. A household borrows to buy a future. Each decision feels rational in isolation, but together, they form a world where the present is always financed by the future. And when enough of society depends on future income, slowing down becomes dangerous because the future is already spent. The second layer is that markets begin to price growth as if it is guaranteed. Investors assume expansion. Banks assume stability. Governments assume refinancing will always be available. The system becomes a cycle of confidence reinforcing itself. Because everyone believes everyone else believes. That is how the experiment becomes self-sustaining. But then the third layer arrives. Intervention becomes normal. When the system is built on belief, it must be protected from doubt. So, whenever growth slows or stress appears, institutions step in. Liquidity is provided. Rates are adjusted. Emergency measures are taken. The machine is kept alive because letting it stall would be too costly. And the world learns a new expectation, that the system will always be supported. This is where early conflict begins to harden, because support changes behavior. If people believe the system will be rescued, they take more risk. If investors believe markets will be stabilized, they chase higher returns. If governments believe borrowing will remain cheap, they borrow more. The experiment feeds itself through the belief that it cannot fail, and that belief becomes dangerous. Because the system grows heavier. More debt, more leverage, more dependency. And London, sitting at the center of global finance, becomes one of the places where that weight is managed, priced, and distributed. The city becomes a hub where the experiment is refined, where new instruments are created to keep the machine running even as complexity rises. But complexity doesn't remove fragility. It hides it. The tension rises because the experiment cannot be reversed without pain. If credit contracts, growth slows. If growth slows, debt becomes harder to service. If debt becomes harder to service, confidence weakens. And once confidence weakens, the system begins to unravel. So the machine keeps moving, even when it shouldn't, even when it's strained, even when it's obvious that the system is becoming addicted to expansion. This is the paradox at the heart of the experiment. The very tools that made modern finance powerful also made it dependent. And dependency is not easily undone, because reversing the experiment would mean accepting something the modern world fears: limits. And once a society is built on the assumption of limitless growth, limits feel like collapse. So the experiment continues, not because everyone agrees with it, but because nobody knows how to stop it without breaking everything. And that is where the conflict becomes emotional, because the experiment isn't just financial, it's psychological. A world built on constant expansion begins to treat stability as entitlement. People expect prices to rise. Markets expect growth to continue. Governments expect refinancing to remain possible. And when the system is designed around those expectations, the idea of slowing down feels like failure. So the machine keeps accelerating. Debt becomes more normal. Leverage becomes more common. Risk becomes more sophisticated. And the public begins living inside a reality shaped by invisible incentives. Housing becomes an asset class instead of shelter. Education becomes a lifetime obligation instead of opportunity. Retirement becomes dependent on markets instead of security. This is what happens when the experiment becomes irreversible. The system stops serving life. Life starts serving the system. London's role in this is subtle but powerful. The city helped perfect the language and machinery of modern credit. It built markets where debt could be priced, traded, and distributed. It built structures that made borrowing feel efficient, normal, even elegant. And because the city is connected to global flows, the experiment spread outward. It became the default setting of the modern world. The build-up toward the emotional peak happens when you realize what reversal would require. It would require contraction, less lending, less leverage, lower asset prices, slower growth. A world where promises made in the past must be paid with real limits in the present. And that would be painful, because the experiment has shaped everything. Companies have built strategies around cheap credit. Governments have built budgets around refinancing. Households have built lives around debt. So reversing the experiment would mean admitting that the future cannot carry the weight forever. But the system doesn't want to admit that. It wants to delay. Delay through new instruments. Delay through policy. Delay through intervention. The machine becomes an expert in postponement. And postponement creates fragility. Because the longer you postpone adjustment, the bigger the adjustment becomes when it finally arrives. That is a hidden danger of an irreversible experiment. It creates a world where small corrections are avoided. So the system becomes vulnerable to large corrections. This is where the tension reaches its sharpest point. The experiment was supposed to make life easier, but it also made life dependent. Dependent on rates staying low. Dependent on markets staying liquid. Dependent on growth continuing. And when a society becomes dependent, it becomes anxious. It becomes sensitive to shocks. It becomes fragile in ways that don't show up in headlines, but show up in daily life. People feel pressure without understanding why. They feel exhaustion without seeing the mechanism behind it, because the mechanism isn't visible. It's the machine. And London's machine helped teach the world how to live inside it. This is the edge of the emotional peak. The realization that the experiment cannot be reversed, because reversing it would expose the truth that the modern world has been borrowing time, and time always comes due. The question is not whether the bill will arrive. The question is who will pay it when it does. That's the climax. The financial experiment couldn't be reversed because it stopped being an experiment. It became the foundation. And foundations are the hardest things to change. The modern world is built on credit, leverage, and the constant pull of tomorrow into today. London helped refine the machinery that made this possible, and once the machinery became global, it became essential, not just for banks and markets, but for everyday life. That's why reversing it feels impossible, because reversing it would mean accepting limits. It would mean allowing asset prices to fall, growth to slow, and debt to become harder to carry. It would mean facing consequences that have been postponed for decades. So instead, the system keeps moving. It protects confidence. It supports liquidity. It stabilizes markets. And in doing so, It extends the experiment again and again. The resolution is not panic. It's clarity. Once you understand the experiment, you stop seeing finance as a distant world. You start seeing it as the invisible architecture shaping your reality. The prices you pay, the opportunities you get, the pressure you feel, the future you're told to chase. It's all connected to the same machine. And today, that machine is still accelerating. Digital money, automated trading, instant settlement. The experiment is evolving, becoming faster and harder to slow down, which means the question is no longer whether we can reverse it. The question is whether we can redesign it before it breaks us. The financial